You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Hello, Jim.
Well, we were always talking about when there's a hot deal, by the time you hear about it, it's probably not hot. Is that absolutely true or quite common?
Well, that can be quite common. In fact, if you go to, I have a little rule about going to conferences. I wait a week after a recommendation is made to see about buying it. The same thing with the newsletters. And it's amazing how often prices come back down to where you were when you first heard about it, and instead of buying at that intermediate or short-term top because of a recommendation that a lot of people jumped on.
After everybody's jumped on the bandwagon and you're already looking for new riches, what are those people going to do?
Well, one of the things they do, which is a subset of this, is that people read about a good idea by someone that they respect and follow their advice, and they wait because they don't want to take a risk. They wait until prices go pretty much where it was expected to be, and then they get real excited to buy because it's been confirmed. And usually that happens right at an intermediate top or a short-term top, and then they have to suffer a loss to get back to break even. A classic example would be people buying late last week in the metals markets, and as you can see, the last couple of days this week has been sharply lower. This is the opportunity when people should be adding to their position on a scale-down basis. But if they bought last week, they're going to be afraid to do that.
Is this another case of you're doing too much in too short of a time without enough thought about it?
Well, that can be the case because you're going to be reacting emotionally. You reacted emotionally last week to buy into this rise, and now you may react emotionally either by trying to sell some of that at a loss, which is not a good situation if you believe your trade is still a good one, and just as bad by not buying more at a lower rate, which you could have done if you bought in tranches where you bought a portion last week. And one of the things I like to do after some of the teachings that I've learned over the years is I decide how much I'm going to buy in, say, 3 or 4 tranches or portions. And on my first one, I decide how much that's going to be of the total amount I'm going to commit. And then in a day like today, I actually will cut that in half because I'd like to take a position, but I also don't want to be greedy, and I might be able to buy more tomorrow at a lower price because prices have been pretty raggedly lower for the last 2 days. So I would go in and buy 1/2 today of what I originally thought I wanted, and if it's lower tomorrow, I could have a tremendous confidence to go in and buy the rest of that.
David, you've always been of the philosophy you don't go all in on anything at any time. It doesn't matter how much of a sure thing it is, and yet you still hear people saying, well, I put everything behind it. They said it was a sure thing.
I know, and it took me a long time to come to terms with that, and I lost a lot of money before I figured it out. You have to figure it out emotionally as well as intellectually. I understood it intellectually a lot earlier than I did emotionally, but it's really true. And especially in this sector, I don't care how certain you are of some particular stock, you've just got to be rational about it, and you've got to know that in spite of all the figures that you read about production statistics or what the company plans to do or what they're doing even, that things come up that can cause some bumps in the road. And if you haven't committed everything to that trade, but you still feel it's a good one, then you can add when those bumps come up. There's one company I'm following which reported lower earnings, and they're going to cut back a little bit on their production over the next couple of quarters. That company is down about 20% over the last 2 days. It's a high-quality company. It's one of the best names in the business, and yet people are selling it because of that one report. And so I'm looking to buy a little bit lower in here than where it is today. I may get a chance tomorrow. But, here's something else that I think is really important. If a person's actions don't fit their belief structure, what they believe about a certain circumstance, it's like almost always their behavior will act in ways that subvert what they're trying to do. So if a person listening to this doesn't believe that we're in a renewed up leg for gold and silver that's going to eventually take it to all-time highs over the next year or so and bring these mining stocks up, by 3, 4, or 5 times where they are today, if they don't believe that and they still feel we're going to see $1,000 gold, then they're not going to take actions that are accord with that belief, and they'll subvert what they actually believe by their actions. We may see $1,000 gold, although it's pretty unlikely looking at the charts now, but anything is possible. But if you still believe, even if we saw that we're still in the bull trend because the charts support that, then you'll behave much differently than if you don't believe this rally that we've had in the last couple months has any validity at all.
You talked about signs that things are going to go well for certain precious metals, and today you said we have an eye on the Golden Cross.
We've been hearing a lot about this technical analysis technique, which has been out there for a long time, but it's very, very powerful, and it's more powerful now because even more people are looking at it and writing about it than was the case a few years ago. It used to be kind of an arcane technique that only dyed-in-the-wool analysts really paid a lot of attention to, but it really gives us some very important clues about the trend of a particular company or even a sector. And by definition, the Golden Cross is when the 50-day moving average moves above or below the 200-day moving average. And if it's, for example, many of the stocks, probably most of them, the mining stocks have been in a position where the 50-day was below the 200 for months, if not a year and a half at a time. And now that's starting to change. Some of the what I call best of breeds have already completed that Golden Cross on a daily basis, where the 50-day moves above the 200-day. And generally speaking, when we see this and when that holds, we have a strong indication that that stock is now in an uptrend rather than a downtrend. And what I like to do is look at the 50, and I try to take action on a choice that I have when that 50 looks like it's going to cross, or just after it does. It's amazing how often you'll see a big increase in volume and price just as that blue line crosses the red line. But what I also like to do to get confirmation is to look at the weekly Golden Cross, and that is usually a much more of a lagging indicator. But when that crosses, you really have clarity. But if you wait for both of those things to happen, you've left a lot of money on the table, and you now have to accept more price risk because the information is factored in, and a lot of people now know that that stock is in an uptrend, and it's moved much higher than it would have been if you had taken action when the daily Golden Cross completed going above the 200-day, at least for an initial part of your position.
How's palladium doing right now?
Well, it's backing and filling because all the metals are a little bit weak now, but you know, you see all the bullish indicators, and the fact is it's still maintaining its breakout level, which I think is very significant. So, and I look at some of the ETFs that have platinum and palladium in, they're giving up their ground begrudgingly. So anybody who has a position in here now, and even if they just have a small profit, I don't think they should be concerned that this is going to be a big washout because the stars just keep lining up behind the PGMs in terms of their supply-demand ratio. And, you know, when it becomes clear to people, I think the move will be even all that more aggressive when it finally takes off. So it's a little bit unsettling in here, but that's the way it is when you don't have a runaway market like coffee does. And that can be bad, really, because now you look at coffee, which doubled in price, the ETF JO that we talked about a couple weeks ago, and now it's down about 25 points. You know, it's given up almost a third of that. So when you see the vertical markets, they tend to go up and exhaust themselves and then collapse, whereas a market that looks like it's struggling, but it's actually base building like the PGMs, and even like the mining shares and the gold and silver shares at this time, that's a base building, even though it's in a wide range, which is frustrating to people because it's not a major trend, and they get frustrated and leave, or they get scared. But the reality is, when you build a base like that, when it finally does break out, then you can see almost certainly it's for real, and you can see real explosive fireworks. So I'd rather see, it's frustrating, but I'd rather see a base that takes longer to build than something that goes vertical like coffee did, and then see it potentially collapse just about as fast.
What happened? Everybody quit drinking coffee?
Not really. It's just that the momentum players turned out and took their profit and went away. And you know, I had Joe that I bought a couple of months ago, and I took a profit about a week ago. It was almost a double. I wanted that to make a double, and if I'd had a little more courage, because I actually had a limit price above that, I would have achieved just above a double. But I took a 95% profit out on that position. I closed it out completely. And now I can look at it without any emotion. And if it goes down, and let's say it retraces a half to two-thirds, I will probably reinstate at least a portion of that position. Because in my belief in studying the coffee situation, I think coffee prices are going to be substantially higher probably for the next several years because of the changing patterns that are going on with some of the coffee growing areas, which I don't think is a short-term thing. And we know that coffee consumption continues to rise, and to a certain extent it's price inelastic. So people are going to drink coffee even if it continues to go up. So I'm looking forward for the opportunity of getting back into that position should it drop substantially lower than where it is today when you and I are talking.
Thanks a lot for chatting with us, David.
Very good, Jim. It's been a pleasure.
My guest has been David Smith, Senior Analyst for the Morgan Report. You're listening to HoweStreet.com Radio. Find us on Twitter at TalkDigitalNet. You can contact us at info@HoweStreet.com. I'm Jim Goddard.